117 points. There you go. Sensex is up 360 points as well. Bank Nifty is up 350 points. So good, solid opening for the market. Topping the charts this morning is HDFC Bank, up 1.5% as we speak. Big volumes on HDFC Bank after the LIC announcement that came in. And straight off the back, it's, I think, 21 lakh shares, 22 lakh shares are traded in early morning on HDFC Bank. ONGC is the other one, 2.5% higher on ONGC. Adani Enterprises, Grasim, Coal India. SBI comes out with numbers on Saturday, so ahead of that, up almost 1% for SBI. Kotak Mahindra Bank, Tech Mahindra, Tata Steel. The Bank Nifty is actually charging away, up almost about 400 points on the Bank Nifty. What's not doing well is Cipla, down 1.5%. Dr. Reddy's comes out with earnings tomorrow. Ahead of that, it's down about 1%. And auto stocks, as I mentioned earlier, a little bit of profit taking is what you're seeing. Bajaj, Eicher are all in the red. Titan is also just dragging its feet a tad bit, and TCS too is slightly under pressure. But otherwise, it's a very strong opening. If you look at, the heat map, you'll realize that there are more greens than reds in the market and good result reactions.
Well, that's right, Sonia. But on the flip side, you have some of those stocks that are taking a very, very hard knock. AU Small Finance back, massive volumes in the first minute itself. It's down close to around 8%, so that one's taking a hard knock. SBI Cards, the revolvers, well, that percentage has come down drastically. And that's the reason why the stock is disappointed. So SBI Cards is down close to around 4% as we speak. Syngene as well, another earnings reaction out there, that's down close to around 2%. And KPIT Technologies, well, that's lost close to around 4.5% and falling on very, very large volumes. What's doing well? GMR Airports, well, that's up close to around 3%. It went around 85 odd, but it's unable to get past that mark. Currently, though, it's opened well in the green, up close to around 3%. PNB posted its numbers, that's up close to around 2.5%. NBCC as well, that's flying away with a gain of close to around 7% as we speak. What else? What's moving from the broader markets? Then you have IFCI. Well, that stock continues to move up. It's up close to around 10%. It's been moving very, very well. In fact, in 2024 so far, IFCI has almost doubled. That's the kind of move that we've seen. It's up close to around 95, 96% in this month itself. HCC, another stock that's up close to 5.5%. And AMI Organics, well, that one's moving very, very well because the release that they put out on the exchange is that their wholly owned subsidiary, that's AMI Organics Electrolytes Private Limited, they have commenced regular commercial operations for manufacturing and supplying of products for lithium-ion battery cells. This was one of the triggers. The stock has corrected a big time from the recent peak, I think, of around 1,350 odd. Today, it's seeing a bit of a bounce on the back of this disclosure that's coming in on the BSE. Prashant.
Nigel, it's PSUs, right? Top of the gaining list. NBCC, IFC, IREDA, SJVN is up another 7%. So this is where the momentum is, and it's sheer momentum, which is driving these stocks higher. Maybe a few other names. IRB is up about 5.5%, which at about 53 or so. It's got tremendous volumes. HCC, these are all smaller stocks, but 6% on this one are doing very well. We got Sterling and Wilson, Solar Wilson, which is up another 5%. Stocks are a new high, 600 plus on that one. So what a move again. It's double basically from the recent low. There's Shakti Pumps, which is locked up 20%. It'll again, it's had a phenomenal 2023, and it's got decent volumes as well. It's some 90,000 shares, and it's right there. Moti Sons is up 5%, so 208 on that one. Subex is up 6%. So lots of names coming up in the broader space as well, which are doing well. So market breadth, by the way, is some 7:1. 6:1 actually, and it's not looking bad at all. On the downside, KPIT Tech is down another 4%. KPIT Tech was under pressure on Thursday as well. I think that after numbers from Tata Elxsi earlier, you got SBI Card, which we mentioned, AU Bank, of course, 8% lower. Cipla is down about 3%. Cipla had a very large positive move on Thursday, so that's seeing some profit booking, 1330 or so. Max Health has been selling off for the last few sessions. It's down another 3.5% at about 706. And there is something like a Scient, which we should put out, which is also down about 4%. So about 1940 on Scient coming through. And maybe a Torrent Pharma. Torrent Pharma starts about 2% lower, 2.25% lower, 2420. So this is where bulk of the volume-led price action is on the downside as well. All in all, I think it's a pretty solid start with about 120 odd points in gain We are around the 21,000, just under the 21,500 mark.
Just one large trade that took place on tips, 5% equity changing hands out there. I think a month or so ago, there was a promoter entity that had sold some stake. We'll have to find out who exactly is part of this deal. But off the blocks, 5% equity right away changed hands on tips. Just thought we'll alert our viewers on that as well. Try to get you further details out there.
All right. So that's tips which is in focus, and that we'll get you details, as Nigel said. Saurabh Mukherjee is with us, founder of Marceles Investment Managers. Saurabh, great to have you with us here on the program as always. Thanks very much for your time. So just a quick snapshot view of earnings so far, the earnings season. Cursory top-down kind of look makes one feel there are more misses than hits. Is it just the base effect at play? What's going on, in your opinion? I mean, if you agree with it.
I mean, look at the top of the rate cycle. This is broadly what you'd expect. You'd expect to see the lenders slow down their earnings growth. You'd expect to see a degree of NIM pressure at the top of the rate cycle. And similarly, if you put it in the global context, given that the global economy has slowed down over the last couple of years, and the global economy too is at the top of the rate cycle, you'd expect to see the Indian IT services companies slow down. So, not surprised that you're seeing a degree of earnings slowdown. That being said, I have never seen an interest rate cycle where at the top of the interest rate cycle, you're still seeing large companies grind out 15-20% earnings growth, and you're seeing the economy grow at around 7%. So yes, it's a slowdown compared to where we were, say, 6 quarters ago. But in the context of general economic cycles, this is one of the most robust economic cycles I've seen, where even after the Western world has hike rate by 5%, you have the US stock market peaking and you have the Indian stock market rocking.
Okay, well, the Indian stock market is rocking. I don't know about that because the last couple of weeks have been rocky, not rocking really. So one just has this question on one's mind that do you see the gains of 2023 being replicated in 2024, or is it going to be a very choppy year for the market? What's your take?
I think we're in good shape, right? I mean, if you look at, let's break it into two parts. I think the small cap piece, everybody watching knows that small caps are up 150% over the last 3 years or so. I think up 45 or 50% in the last 12 months. But let's focus on the broader benchmark, the large cap benchmark. Even there, we are up in high teens. The Nifty is up high teens. Earnings compounding for larger companies are anywhere between 15 to 20%. So we're in good shape, whether we look at the market as a whole or at small caps. In small caps, I would dare say there's a degree of irrational exuberance, but that can be discussed later. For the market as a whole, we're in good shape. The US stock market is also at all-time highs. But coming back to the year ahead, if you have political clarity, which I think we have on the situation now, you have government capex moving along, and I think the union budget, the interim budget will further underscore that government capex will grow at a reasonably solid pace. And if you have the early signs of a private sector capex upturn, which I think again we have, early signs of a private sector capex upturn, I don't see any reason why 2024 shouldn't also be a good year for well-run large cap companies.
All right. Hi, Saurav. Good morning. Good to see you. Saurav, Street has been a buzz with regard to your entry and exit of various stocks. But there's a couple of stocks that I think that you have made an entry into. Amy Organics, I think that's one of them. Control Print, I think, is another one of them as well. And we have some news flow this morning on AB Organics with regard to the lithium-ion battery, that what they've been talking about for a while. Tell us more about these two recent entries that you've made.
So look, we've been researching Amy for 6 months or so. We held off buying because, given that we buy reasonably large chunks, we were finding it difficult to get a block. Thankfully, and this is entirely fortuitous, there was a block available around a month or so ago, and it was available at a very attractive price. So we got in, I think, around the 1050 odd level, or perhaps a little lower than that. We got in at an attractive price. Why did we get in? Amy Organics supplies intermediates to some of our larger pharma holdings. So, for example, Amy Organics supplies intermediates to Divi's Lab. Divi's Lab is the 5th largest maker of APIs in the world. As I've said several times on your channel, we think there's a big story playing out in India on APIs. I think we'll pull market share from China as a country. We will pull market share from China. So Divi's Lab does well. A supplier to Divi's like Amy should do well. A different part of Amy, the lithium-ion piece, that's a business based out of Noida. That's a business they acquired a couple of years ago. And looking at India's import-export data, we figured out that this is a very high margin that Amy is involved in. Basically, they're supplying stuff into the ecosystem, going not just into EVs, but also into the semiconductor ecosystem. So we felt that for the price that we were paying for that block deal that took place a month ago, we were getting a credible supplier to Divi's lab and to some of the largest European pharma manufacturers, and a company which could play the semiconductor cycle and the EV cycle. So you're getting two for the price of one, and thus the entry into Amy Organics now Little Champs portfolio.
Saurabh, the other one I think we should talk about is, of course, HDFC Bank and what your thoughts are there. I did read your note to I think, which you wrote on HDFC Bank assessing, where it stands on various parameters. But just talk to us about what do you think is going on there, and what's your own sort of sense? Will one make money in HDFC Bank from here?
Look, I think from our perspective, we certainly hope to make money. It's one of our largest positions. In fact, I think it's probably 10% of some of our portfolios. Why do we hope to make money here? Let's break it into two parts. The fundamentals piece has been good for 25 years. I don't think anybody watching this show needs to be reassured on HDFC Bank's fundamentals. It's been 20% loan book growth for many, many years. Over the last 6 months, over the last 6 years, take any horizon, this bank has pulled market share at a rate not seen in Indian banking. No other private sector bank, even in the current fiscal, no other private sector or public sector bank has come close to matching the rate at which HDFC Bank has pulled market share. Now, the concern that's historically existed is it's an expensive bank. That's been the point of view historically. Over the last 5 years, the price to book has come off from, I think, 4.5 down to now 2 almost. This is trading at the lowest price to book it's ever traded at. And therefore, that's why in the last 6 months, we increased the position size quite sharply in HDFC Bank. Obviously, the events of the last 2 weeks hurt us. When a bank of this size, in a position of this size, comes off, it hurts us. But our point of view is that the issues that the market is losing sleep about are transitional. And all the data that we get, data coming from the RBI and from the bank itself, suggests a franchise which is steadily getting more muscular relative to even the other private sector banks, and hence the increase in position size, and hence the relative sort of sanguine point of view in Marceles that yes, you could have perhaps another quarter of weak deposit growth. Remember, loan growth is not the challenge. The concern that people have is deposit growth. Perhaps you have another weak quarter of deposit growth, but that's a transient issue. The structural point of view here is that you've got a bank doing 1.9% ROA. If you gear that by 8, 9 times, an 18% ROE bank, trading at 2.2 times, 2.3 times, to my mind, that's a very attractive proposition. Quick disclaimer, myself through Marceles, my parents through Marceles, and our 9,000 clients through Marceles have investments in all of these stocks I'm talking about.
So you're a buyer at these levels. You continue to remain positive for the stock, right? At these levels.
Absolutely.
Okay, all right. You briefly mentioned at the start of the interview as well about the private capex theme. And in the past, you've been quite positive about that. If there are signs that it's coming back, how do you play it? What are the themes?
So far, we bought RHI Magnesita 4 or 5 months ago. This is a company which supplies to steel plants, the refractory material which goes into steel furnaces. We bought Grindmill Norton a couple of years ago. This is a company which supplies abrasives to, say, an auto manufacturer like Maruti, say. More recently, over the last 3 months, we've built positions in Shanti Gears. This is the second largest gears company. It's part of the Murugappa empire. The largest player is in Gujarat, but we think the largest player is losing market share to Shanti Gears. And we see this very much as a company that will do really, really well over the next 4 or 5 years as the Murugappa group improves the quality of Shanti Gears' business and turns it into a market leader. We've also bought SRF. SRF is a multinational. They are the largest player in industrial bearings. So broadly speaking, the bearings market is 2 parts, one which supplies the auto community, the other which supplies the industrial community. SRF is the largest player in industrial bearings. The stock hasn't done much over the last 12 months, largely because bearings demand hadn't taken off. We reckon as we go forward, the industrial capex cycle picks up, demand for industrial bearings picks up, and SRF should be a beneficiary of that.
SKF, I think, right? SKF.
Sorry, yeah, SKF. You're right. Sorry,
SKF.
SRF is the chemical company. SKF is the ball bearings company. Thanks for clarifying that. Thank you so much. Yeah.
Okay. What about some of these spaces like IT, for example? How are you feeling about them, and any of the stocks that you like over there that could do well in the near term? Because there the street is a bit divided on which way things are headed.
So IT maintained the point of view over the last couple of years as the Western economies have slowed down and the Fortune 500 companies' desire to give work to Indian companies has come diminished. Our point of view has been that look, AI is upon us. The move to cloud is upon us. The bulk of the Fortune 500 companies haven't yet moved to cloud or AI, and the two are linked. It's very difficult to move to AI if you don't move to the cloud. So the bulk of the Fortune 500 haven't done that. And therefore, there is plenty of work to be done for the big Indian IT companies. It's not just a theoretical thing. We can see quarter upon quarter the order books of the Indian IT companies bulging up, right? So TCS reports anywhere between $8 to $10 billion of business. And if you can see the order books going up, it's just a question of being patient and saying, at some stage, the Western CEOs will give the green light to a TCS saying, go ahead, get the work done. We need to move to cloud and AI ASAP. Now, when that green light will come, I can't second guess that, Sonia. We try our best to be reasonably sensible about these things. And our view is that we keep the position, stay invested in a large way in TCS. In the engineering R&D space, we invested in LTTS and Tata Elxsi, stay invested there. And just wait for the Western economic cycle to turn. Now, if the Western economic cycle turns in the next 6 months, brilliant for our positions for our position in TCS. But if it turns next year, so be it. We'll have to stay patient and wait for the IT services cycle to turn. We think it'll turn. It's a question of when, not if.
Yeah. Okay, all right, Saurabh. Thanks a lot for joining in, giving us a view on various sectors as well as stocks. I look forward to having a chat with you and wishing you all the best. Sometimes, timing of these stocks is a little bit difficult, but hopefully things, work in favor of all the money you're managing as well, Saurabh. Well, let's move on. Let's focus on JSW Steel. Well, that one delivered a good set of numbers. I caught up with Jayant Acharya, joint MD and CEO of the company, to discuss their past quarter's numbers. Let's hear out what they had to tell us. Well, I began by asking them about their India EBITDA outlook and also the cost of coking coal. Listen in.
Our India operations EBITDA was about 6,923 crores, which translates to about 11,900 rupees per ton, about $143. Our NSRs went up, our realization went up marginally. We did increase prices in October, but however, there was a pressure from imports, increased imports and low-priced imports, due to which the prices did correct during November and mostly December. Our coking coal cost, we had indicated, would go up by $20 to $25. It went up by close to $21 in the last quarter, and that impacted our cost, including the price increases on iron ore. So the costs were higher. It was marginally offset by some improvement in the NSR, which we could manage through a better blend.
Got it. What about for quarter 4? What is the price realization we should be working with in comparison to quarter 3? And also coking coal cost, as you mentioned, it's up by close to $21 per ton for the past quarter. For this quarter, what should be the rough estimate that it moves up by?
So coking coal prices, Nigel, are still elevated, and we are seeing numbers close to 330 FOB Australia. We are continuing to see elevated numbers probably for January, March as well. We probably would see an increase between $20 to $25 in our blend cost in quarter 4 as well. Iron ore prices have also gone up, so to that extent, cost pressures are there, which would put pressure on the margin. Having said that, from a pricing perspective, I would say that the global steel prices have moved up, and that is something which has done two things. One, it has opened up the international market, so the export volumes are improving. The realizations are better. And now the import prices and our domestic prices are close to parity after the increase in global prices in the past few weeks. So therefore, the import will be lesser. So from a volume perspective, I think you will see in India the imports falling, the exports going up, and therefore that would balance quarter 4. So from an outlook perspective, I would say that quarter 4 will be better. Seasonally strong quarter supported by export volumes. And we do expect that the global steel prices, which are higher, would reflect in the Indian market in the coming months.
So just a short point is EBITDA per ton in quarter 4 for India business looks like it'll be as good or a little bit better than quarter 3. Are we getting that correct?
It's difficult to comment on the margin per ton, Nigel, but the way I would like to say is that the costs are going up because of coking coal and iron ore, and it will be partly made up by a better blend of exports, some improvement in the prices which we foresee in the domestic market, and a stronger volume overall. So the absolute numbers will get a push from that.
Okay, all right. A couple of your subsidiaries have done really well out there. You know, the Italian business seems to have bounced back in comparison to the last quarter. So give us a sense about how international operations are shaping up. You know, do you expect a further improvement? Point number one. And point number two, Bhushan Power and Steel, the asset that you acquired, well, that's ramping up very, very well. What's the outlook out there? If you could give us an EBITDA per quarter run rate.
So from an overseas operations first, I think overseas operations have done quite well, as you rightly said. The production levels at Ohio have been very good. We did good productions in Q3, and our capacity utilizations have improved to 74% from 42% odd in the previous quarter. And we expect that the volume story will continue in the Q4 as well. Baytown has done very well, with respect to the EBITDA overall on their business, and therefore we have seen an overall positive EBITDA from the overseas operations in US. Italy has done particularly better, again on the backdrop of rail orders, which we have both from the Italian government as well as from the export side. Italy has done better, and we expect that the Q4 volume and the EBITDA levels will continue this momentum. So overseas operations has done well and will continue to be, I think, in a similar kind of situation in Q4. BPSL has done better. BPSL from a volume perspective has done better. The EBITDAs have improved to some extent in the Q3. However, we expect that in the Q4 they will do slightly better. One, because the volumes are increasing because our new phase of expansions are getting commissioned, and that would add marginal volumes in this quarter and balance in the next quarters. And from a cost point of view, because we have commissioned some of the cost-saving projects in BPSL, they would be able to gain on some of the cost advantages in this quarter. So it should reflect in terms of EBITDA per ton better than what we have seen in Q3. Got it.
All right. What about, a couple of steel assets are on the block. Is JSW interested? I want to ask you point blank, is JSW Steel in talks with Vedanta for their steel unit?
So, Nigel, I think we have discussed this question in the past as well.
No, but I want an answer, sir, this time, because the street is a buzz that it's a possibility.
Yeah, so we had mentioned earlier also that our interest is more on the mining side of their business and not as much on the steel side because it's a smaller steel operation. And we maintain the same thought process today as well.
All right. So you're in talks for Vedanta's Karnataka iron ore mines, because that would be a natural progression, right? It's y'all require iron ore, they have that. So y'all would be interested in Vedanta's iron ore mines.
Right.
What if they're not selling only the iron ore mines and they're selling it as a package? We will take the steel unit as well.
We will see. That is a part of the discussion which will, I think, emanate over the course of time. But as I said, our focus would be on the mining assets and not as much on the steel assets.
Final question. What about budget 2024? What's on your wish list?
I think this is an interim budget. So from that perspective, what we do expect is from the government is that they would continue their infrastructure investment, the public capex, which has really done well for the country at large. The manufacturing push, which is happening through various incentives and schemes which the government has laid out, is also doing well. We expect them to continue this journey with respect to the growth of the economic activity. And on one concern which we have is that the imports are going up into the country. India is doing well. It's a bright spot in terms of economic growth in the world. We should be wary of cheap imports landing into our shores and hurting the investment of Indian manufacturers. maybe appropriate steps need to be looked at as we go along.
All right, that's the word coming in from JSW Steel, but please don't lose sight of what's happening in the market. It's a big, big up move. Almost 200 points higher on the Nifty, up almost 1%. If you're wondering why the market is surging so much, the big question that everyone's asking is, are we staring at a clean victory for the NDA government in this election? And that, of course, will provide policy stability, right? The recent developments in the last few days have suggested that, whether it's Nitish Kumar switching sides, whether it's Mamata Banerjee going alone in West Bengal, what's happening with the India alliance, weakening, etc. All of that put together, the market is stitching the fact that perhaps there could be a lot more policy stability as we move into the elections, and maybe that's what the market is pricing in. A couple of good earnings as well coming through, so let's get straight to it. Chola Investment is on our radar right now. Company reported a good set of earnings for Q3 with a strong AUM growth and significant improvement in the asset quality, which is now the best in 3 years. Arul Selvan, who is the president and CFO of Chola Investment and Finance, joins us now to talk about that. Mr. Selvan, good morning, and always great speaking to you. Your company has reported consistently stable numbers over the last many quarters, and this quarter as well, asset quality has improved. So can you just start by taking us through that? What is the outlook in terms of the asset quality going forward? Are you seeing signs of stress anywhere at all, or do you think that this kind of trajectory is something that can continue?
Yeah, our asset quality will improve in the coming quarter and even in the coming year. As in the normal way that happened pre-COVID, in Q1 of FY25, you may see some little bit of a, either it is staying at where it is, or it may even deteriorate a bit, but because Q1 is always a bad quarter. But post that, we will again move forward in reducing our NPA numbers. And we see headroom to do this even in the coming year. So you will see improvements in Q4 and in FY25 in both in the NPA numbers and as well as in the NCL numbers. And that's what we are confident about as we move forward.
Okay. So when you say further improvement in asset quality, what are you targeting? You're already sub 4% right now. Any internal target that you have by the end of FY25? What would the gross NPA percentage be?
I don't want to give any forward-looking statements. Yes, we should see a considerable drop in Q4. But as I said earlier, Q1 we may lose that a bit. But then again, we will move forward to reduce this. The target would be to bring it closer to the 3.5% level over the next few quarters.
Mr. Selvan, hi, good morning. Prashant here. You had said that in the unsecured personal loan segment, where the growth was being led by fintechs, etc., you will moderate that growth, you will recalibrate that growth. Can you tell us what's happened there, growth rates and asset quality for that segment?
See, the unsecured segment, we are doing it broadly into two categories. One, through our own team, and partly through the fintech team. The fintech team, we have been moderating it. I earlier also articulated that we had, moved away from one or two fintechs with whom we had been associated with. But with the rest, we are moving forward, but in a very, controlled manner, because we don't want to also be seen that we are, going away from the directions given by the regulator. So to that extent, we would be, carefully watching it and then growing it. But there is potential to grow, and we will certainly capitalize that in a controlled manner.
All right. Hi, Mr. Selvan. Good morning. Good to see you in. You had indicated that the cost of funds will go up a little bit because of the new RBI norms by around 15 to around 20 basis points approximately. So for Q4, how much will the cost of funds go up in comparison to Q3? And what does that mean in terms of NIMs? Because NIMs were stable in the past quarter. Please go ahead.
Sorry, the cost of an increase, which was expected to happen, which I spoke about earlier, I think most of it has come through. And that's where you would see certain amount of cost of an increase this quarter. But that had been offset to a large extent also by yield improvements, which had happened in the case of vehicle finance, which was our, portfolio which was under the fixed rate, and progressively it is changing color with a higher yield coming into play. So you will see that happening in the coming quarters also. In my opinion, we are at the cusp of the cost of funds peak. Unless something new comes up to by way of the regulatory interventions or some global incidences, I don't see cost of funds going up from here. I am also not subscribing to a very fast rate cut. So I would say rather we would be on a sort of a plateau at the cost of funds level as we move forward into the next financial year.
So the NIMs will stay stable, what we have seen in the past quarter?
NIMs will stay stable, and it will also marginally improve as more of the vehicle finance book gets into a higher yield.
Got it. All right. So give us a rough mix then in terms of, what is the AUM growth guidance first? What do you end FY24 with, when FY25? And new business, there was some mild degrowth in the past quarter. And as a percentage as well of the total mix, it came down a little bit. Where do you see that number stabilizing, AUM growth, and also the part that new business has to play?
See, I still stick to what I said earlier, that the full financial year FY24, our growth would be in the range of around 30 to 32%. And as you would have seen, it has moderated from the 47% levels to 36% levels as we close this quarter. But this is primarily because the base in the previous year has been higher in the third and fourth quarter, and that is what you will see come into play to bring down the overall growth. So you'll see this in the 30 to 32% growth for the current year. And next year, right now, I would rather be conservative in saying that it should be in the range of around 20% plus. I wouldn't want to put anything beyond that right now.
Okay. Can you give us some...
Yeah. Go ahead, sir.
Sorry,
new business.
Sorry, you asked about the new businesses. So I wanted to cover a bit on that. We stick to the old proportion that we discussed again. Over the next 2 years, vehicle finance should be in the 50% range, and the mortgage businesses in the 35% range, and the new businesses in the 15% range. I think of which the unsecured should not be crossing the 10% level.
Okay. I just wanted a quick qualitative view on what's happening with the rural market. Are you seeing any signs of improvement? Because, some of the vehicle financing spaces, like say for tractors, for example, right, have been under a lot of pressure. So what are you seeing overall in rural?
Yeah, in certain geographies, tractors are under pressure. So we are also slowing down in those geographies. But I think overall rural, there is still a large amount of, earning potential that is yet to be realized. And elections around the corner would bring that into the forefront, and you will see a lot more vehicle hiring as well as, money in the hands of the people to spend, which consumption increases the requirement for vehicles, especially the category of vehicles we cater to, which ply in the rural. So we see good traction out there with regard to our vehicle, population and our borrowers earning better in the coming quarters.
All right, we'll let you go on that note. Thanks a lot for joining in. That's Chola Investment. Asset quality has improved, and they expect some seasonal woes in Q1, but otherwise things are looking fine. Things are looking very good for the market, so keep tracking that. When we come back after the break, Warren Kevin Harris, the MD and CEO of Tata Technologies, will be joining in to discuss their numbers. Stay tuned.
Okay, welcome back. You got the market, which is roaring. I mean, 190 points higher. So I just want to quickly maybe take 30 seconds and tell you the big movers. And it is public-sector names which are doing bulk of that roaring I was talking about. RITES is up 11%, NBCC is up 7%, SJVN is up 7%, and IFCI is up another 10%. So this is, the part of the market which is looking very, very good. The other part is the Adani Group stocks. I mean, there is a report from Cantor Fitzgerald, which is an old seasoned broker, and they have a note out on Adani Enterprises. Maybe we could look at Adani Enterprises on your screen. Started slow, 1% higher, but pretty much at the day's highest point with a 4.5% pop at this stage. Well, let's talk about Tata Technologies now. The company reported a steady quarter for the third quarter. Revenue growth slowed down a little bit in the third quarter compared to the first half. We have Warren Kevin Harris, Managing Director and CEO at Tata Technologies, joining in now. Warren, good morning. Great to have you with us here on the program at CNBC-TV18. We interacted during the IPO time, and it's good to have you back and speak with you again. Revenue growth at about 11.6% is slower than the first half growth of almost 15.5%. Could you tell us what happened? There was a ramp down as far as the second largest client is concerned. Is that largely responsible? I mean, and is bulk of the ramp down behind us?
Yeah, well, first and foremost, thanks for the opportunity to join you, and it's great to see you again. Q3 is typically a seasonally soft period for us on account of the festivals in India and the Christmas and the New Year holiday in different parts of the world. We did get impacted by the transition at one of our Southeast Asian OEM customers. We are at the end of the development of 2 electric vehicles that we've completed for that company, and we are transitioning from engineering to launch support. And so there are teams that are coming off of that engagement, and we are repurposing those teams with other customers. So the converged impact of that did contribute towards tapered growth in Q3. We began the transition within that customer in Q2. It accelerated in Q3, and we should be largely through that in Q4. And we are looking very much forward to renewed growth in the beginning of the new fiscal year.
Warren, this is VinFast, the Vietnamese EV maker, right? I mean, I'm not sure. There's enough which has been written around.
Yes, yeah, it is VinFast. That's right.
Yeah, and there has been trouble at the company. I mean, the share price there, the stocks have fallen quite a bit, etc. All of that. Is the business for you going to? Are you saying that it's going to pick up again from the next quarter on, or are you saying that you'll move on to other customers and you'll make up for this client through other work? Is that what you're saying?
We're very proud of our association with VinFast. We think that we've done great work with that company, and we're very proud of the 2 vehicles that we will launch together. But as with all new energy vehicle companies, once they have developed a portfolio of vehicle, their focus shifts to building brand recognition and building and selling vehicles. And we expect that to happen at VinFast. And we expect that will be their focus for the next couple of quarters. But they are building manufacturing capacity, not just in Vietnam, but also in the United States. And that will require, at some point during this calendar year, a recommitment to the investment in new products. And we expect very much to be a part of that.
Warren, hi, morning. Just to follow up there, what is the amount of revenue that was lost because of the ramp down from VinFast?
We're not in a position to disclose the specific amount of revenue at any one customer, but it was material. And the good news is that we anticipated it, we planned for it, and as I said before, we've repurposed most of the resources onto other customers and other projects.
Sure. So you can't share that number with us, got it, but you're saying it was material. 85% of your business comes from the automobile space. So just trying to understand, are you anticipating any more such ramp downs from any clients? How is the situation on the ground at the moment?
No, the situation at VinFast is again consistent to the type of volatility that we see with new energy vehicle companies. But if we step back and we look at the broader market, the demand continues to build, and we're very bullish about our prospects as we move into the new fiscal year. Despite the macroeconomic challenges that are playing out in different parts of the world, we do not see that impacting in the short term the demand cycle within automotive.
Okay, all right. Hi, Warren. Good to see you in. Nigel on this side. There was some improvement in your margins, which is good news. I wanted some further clarity. What's the outlook in terms of margins? And also, what drives your services margins that are better than the industry? And is there scope of improvement on the technology solution side as well?
Yeah, great question, and Nigel, thanks for the interest. We saw 140 basis point improvement in margins in the third quarter, but that was really largely informed by a business mix change in the second quarter. For VinFast specifically, we did a lot of test and validation that we brought in from testing houses in different parts of the world. We also rolled out a relatively generous salary increment in the second quarter. What we've seen in the third quarter is improvement in our offshore percentage. We've also worked very hard on our people pyramid and also various productivity measures, which I think is a testament to the rigor and the discipline that we've interjected into our operations. Now, I don't anticipate that we'll see 140 basis point improvement every quarter, but we are working hard to squeeze out incremental improvement in margins as far as services are concerned. I think as far as technology solutions is concerned, the end of the calendar year for our product business is typically associated with a lot of maintenance renewals in the United States specifically. That's typically at a lower margin than new product sales, and so we would expect margins in that business to improve this quarter and beyond.
Just a quick question on Tesla, which is one of your clients. The stock has been under a lot of pressure. Elon Musk has spoken about growth being under pressure as well. Your thoughts here?
Well, I think what we're starting to see is the sort of preeminence that Tesla have enjoyed over the last 10 years be challenged by every OEM in the automotive space. The pivot towards electrification and connected has very much happened, and I think that the rest of the market is making good progress in terms of capturing the position that Tesla previously enjoyed. Now, I think we've all learned over the last 10, 12 years never to count out Tesla. And I think, the innovation and the advantage that Tesla has, particularly in and around their previous investment in software-defined vehicles, continues to augur well for them. But I think that what's playing out is the rest of the market is playing catch up, and we're starting to see that in different parts of the world.
More competition, certainly. Warren, great having you with us here. Thank you very much for your time, and we wish you all the luck as you move forward into 2024. Thank you very much for joining us there. So that's Tata Technologies. All right, what we'll do is we'll focus on Adani Enterprises. It's up about 4.5% or so. Cantor Fitzgerald, which is a broker, they've initiated coverage on Adani Enterprises. A detailed report. Hormuz is here, standing by to tell us more. Hormuz.
Cantor Enterprises is calling Cantor Fitzgerald, it's calling Adani Enterprises too big to ignore, and as a result of which it has initiated coverage on the stock with an overweight rating, and its price target of 4368 is a potential upside of 50% from Thursday's closing levels. And the note in its very beginning says that Adani Enterprises is the core of everything that India wants to accomplish going forward, and the current valuation does not reflect all the parts of the company. Now, what they also mention is that the lack of analyst coverage that Adani Enterprises has has been a key hindrance for investor education on not only Adani Enterprises but all of Adani Group companies, and all that the investor community knows about the group is because of the Hindenburg report. And they also go on to say that the country needs Adani as much as Adani needs the country, and they have valued the company based on 3 core businesses. One is the airports business, which they have valued at 1622 rupees, the roads business, which they have valued at 1525 rupees, and the solar, wind and electrolyzers business, which they are valuing at around 1500 rupees. Now, what they have also said is that Adani Enterprises being the incubator company of the group, and that approach is the prudent one, because going forward most of these businesses are likely to get demerged, and the valuation since they are valuing the company only on 3 main businesses, the rest of the 6 investors are getting the rest of the 6 businesses relatively for free. And lastly, they are saying that the risk reward is favorable at current levels, which is why there is this overweight rating and a 50% potential upside.
All right, thanks a lot, Hormuz, for that. Well, let's talk about Shriram Finance, which is surging today on the back of a good set of numbers. Their AUM growth is strong, disbursements have surged, while loan growth is better than analyst estimates as well. Y.S. Chakravarti, the MD and CEO of Shriram Finance, joins us now. Mr. Chakravarti, thank you so much for joining us. First, if you can start by telling us about the growth that you've seen, right? Not only growth, I mean, asset quality has also improved. But first, on the growth front, what are you expecting to see by the end of FY24 in terms of disbursements? And what do you think both AUM and disbursement growth could look like by the end of FY25? I think, Mr. Chakravarti, you're on mute. If you can just unmute yourself.
Sorry about that. Thanks for having me here. We've grown by about 20% in this 9 months, and we estimate that we will be able to hold it, grow the 4th quarter also. And for the year, I think we are looking at 20% AUM growth. Probably the next financial year, the growth may be slightly muted. We are projecting anywhere between 15 to 18%. For FY25.
Okay.
So that on the front.
Got it. Mr. Chakravarti, I think the standout point in your results has been your margins. I mean, able to improve at a time when the Reserve Bank actually went the other way. Now, the Reserve Bank actually imposed those costs mid-November. So will current quarter, you'll get the full impact. Can margins still be maintained and improved upon?
Improved upon, no. I think we'll be able to maintain the margins here, Lata, basically also because we do not have much of an unsecured portfolio. As you know, our personal loan portfolio is only about 4.6% of the portfolio. So some of those costs we were able to pass on, and a little of it we could absorb. Another reason why the margins have improved is also the change in product mix. You know, Q3 has been good for the retail, particularly my particular and MSME portfolio has grown well. So we have for margins.
Oh yes, you've done exceptionally well on commercial vehicles and personal loans. You could actually bring down. So the risk weights didn't hurt, but it will hurt your cost, isn't it? Because for banks which have exposure to NBFCs, the high risk weight is higher. So did your cost of funds go up in the quarter gone by, and will it go up even more in the current, in Q4, because again of the full impact?
Point number one, our total borrowings from bank, out of our total borrowings, we have only about 26% from banks. So whatever is the increase in bank rates would not hurt our numbers badly. Number one. Number two, as of now, we have seen only a couple of banks who have increased the rates, but going forward, probably we may see a 10-15 bips of increase in bank cost of bank borrowings, but that I don't think that should impact negatively. We should be able to have and maintain our margin rate 8.1, 8.2%.
No, but 8.99, I thought.
No, that's for the quarter.
Okay. Okay, for the full year, it's for the 9 months, it is 8.1.
8.65. It is 8.65, somewhere around 8.6, 8.65 for the 9 months. So for this financial year, we should be able to manage that. We'll see what happens next year.
Okay, so you're not guiding for next year. You're only guiding for the moment for the quarter. Okay, Prashant.
Mr. Chakravarti, hi, good morning. Prashant here. Just 2 points. One is you're saying 24 AUM grow 20 and then 25 between 15 and 18%, right?
Correct.
What's making you a little more conservative? I mean, are you just being conservative or are you seeing some slowdown?
No, we are always conservative. In fact, at the beginning of the year, we've guided for about 16% growth. So
and you will end up at 20. So should probably see you repeat.
So if you're guiding 18, we should do better than 20 by the current year standards.
I mean, there are also some uncertainties. So let us see how this goes.
Right.
That was going to be my question, actually. You know, normally the expectation is during elections or just before elections, construction activities slows, ordering slows. Have you seen any of that at all? Because your CV sales have done so well, will Q4 be a repeat or will it be a little moderate?
Sorry. On the commercial vehicle side, no, we have not seen any slowdown on the new vehicles. But anyway, the used vehicle market has started showing good signs of growth because the replacement market the replacements are happening. So on the commercial vehicle side, I don't think we will see any slowdown in the next couple of years. I expect it to continue at the 12-13% growth for us on the commercial vehicles. The other products would slightly grow faster, but then we have also muted our personal loan growth. So personal loan also should grow by about say 17-18%, but it's on a small margin. So overall, looking at, as I said, anywhere between 15-18. It's not a pessimistic estimate, but I would like to be conservative.
Okay. Mr. Chakravarti, slippages and write-offs, they also, in the quarter I'm talking about, also kind of normalized, right? 2%, 1.5% respectively. Could you, what's going to be the broad trajectory, you think, as we look into 25?
See, as of now, I think we should be holding it here, the credit costs. We are actually working on improvement. You could also see a slight improvement going forward. But the credit costs, we want to hold it around 2%. So I think we should be able to hold it there in the coming year also.
Okay.
If there's no shocks to the economy.
Okay, sorry. I was just wanting to rush to the other big news. Shriram moving out of, Piramal moving out of Shriram, and the sale, the purchase has been done by the trust. Anything we should know about the capital structure? Will you all want another PE, or are you in the know of another PE fund wanting interest? After all, you all are in a superb growth phase, and India is such an attractive destination. Are you all in is this a temporary parking with the trust?
No, I don't think so. I think the trust when Mr. Piramal expressed his desire to exit, I think the trust wanted to buy up. Okay. It's not a parking. The trust is wanting to hold it. The trust is actually a beneficiary trust. So whatever surplus they have, they would like to invest it and buy it back.
Okay. No, I can understand their desire also to increase stake. But just wondering, since a big kind of PE investor moved out, I was wondering if any more have shown interest and want to come in. Would you be in the know?
We are not in the. As far as I know, the SOT is not in the lookout for any more investors.
Okay. What about capital raising itself? The RBI's new rules have not really eaten up your CRAR, but the market is kind and your stock is ascending. So will you all use it to raise equity, raise capital at all?
We have not started the discussions as that, but as you said, yes, market is kind. So probably we'll come back to you in a month or so and share with you if we have any plans.
Okay, since I was first to ask, I hope we will be the first to learn about it. Yes, Mr. Chakravarti, pleasure speaking with you, and good to hear that there is a decent year ahead and you are, not seeing the margins peak off in this quarter as well. Thank you very much for joining us. Many congratulations.
Thank you.
We have to take a quick break. Thereafter, Manisha will be with us to speak about commodities, and that's big news there. Crude has climbed, so back with that. Welcome back. We're all mesmerized by the 1% rise in stock indexes. Then what will you speak about? Crude. That's gone, 3% higher? Manisha is here to tell us where this important commodity is headed. Manisha.
Thank you for that, Lata. Well, the crude oil prices are trading at around 8 weeks high, which is a 2-month highs. And we've seen strong gains in the last couple of weeks itself. And that is what is keeping the prices at around $84 a barrel on your screens. We have seen strong gains come in on a weekly basis as well, 4.5% on the higher side. And for the month of January until now, for 2024, we are up by nearly 10%. And that's exactly the loss that crude posted for all of 2023. So we've recovered all of that in the first month itself. Well, markets also are looking at a strong range that seems to be building up right now. So when you look at the month of Jan, if you look at the range, that is 84, of course, is on the higher side. But we started this year at around 78 on the lower side. So $6 of a jump up is what we've already posted in case of crude prices there. The markets are looking at various factors to begin with. It has to do with the Houthi attacks on Red Sea. And this time around, it has been on a fuel tanker from Trafigura. So now we are looking at direct attacks on fuel tankers, and that is adding premium to prices. There are supply concerns coming up now. The second point really is about Russia, where many of the refineries have gone in for maintenance. And this is after drone attacks on various refineries. So they are under repair. So Russian crude also will continue to decline into the international markets. That's weighing on. That's rather supportive of the markets there. And then the street is also dealing with the strong U.S. economic growth numbers. The GDP numbers, remember, were on the positive side. And the China stimulus numbers also continue to support. The U.S. dollar index is slightly on the weaker side. That is supportive. And the money managers have raised their net longs on crude futures and options as well. So everywhere that you see, there are strong fundamentals and there is smart money moving in case of crude. And that is what is keeping the prices at around $84 a barrel. Now, going forward, it is going to be about the OPEC and allies meeting. This is an online meeting. It's on 1st of Feb, where there will be statements from OPEC and allies on future growth and supply as well. So Street will keep an eye on that. Apart from that, it also is going to be about the first FOMC meeting of this year. That is on 30th and 31st of January. So while, of course, a rate cut is not anticipated, but the Street will watch out for guidance, and that will keep the markets choppy. But at this point in time, definitely supportive.
Okay. Well, that's really good for the oil bulls, but it's not casting any shadows at the moment on Indian equity. So we take a break, and on the other side, we get we keep continuing with our results analysis. Atul Kumar Goel, the Managing Director and CEO of Punjab National Bank, will be joining in to talk about their third quarter numbers. PNB's Q3 interest income and margins beat expectations, and the highlight was a huge over 2,000 crore rupee recovery from written-off accounts. The bank's profit also did not disappoint, despite the fact that it used some of its profits to actually increase its provision coverage ratio and also to provide for wage settlements. In spite of it, the profits were in line. The margins remaining flat again is a huge positive at a time when all banks are announcing a fall in margins. Joining me to discuss the results is Atul Kumar Goyal, Managing Director and CEO of Punjab National Bank. Good morning, Mr. Goyal. Thank you very much for joining us. Well, margins, that's the talking point. The fact that you have been able to maintain that, your loan yields are up. Can that continue in Q4 and next quarter as well, this maintaining margins?
Very good morning, Lata. As far as the margin is concerned, the global NIM is 3.15 as against the domestic NIM of 3.30. So we have given the guidance for the whole of the year. It will remain in the range of the 3%. So we are confident we will maintain 3% NIM also. As far as your question regarding the yield also, the yield definitely, because on account of the recovery from the NPA account and the assets quality has improved, so we are hopeful whatever the yield we have got in the 8.54%, it will remain sustainable also.
Okay. But will, the big point this quarter is that, as you pointed out, loan yields went up for other reasons as well by 30 bips quarter on quarter. But your cost of funds have gone up only 10 bips quarter on quarter. Are they likely to go up further because there is this mad rush for deposits?
You are very much right. The increase in the cost of deposit was hardly 10 basis points. So I do not foresee, although there is an increase in the interest rate in the last 1.5 months, but because we are having the 42 or 43% CASA and my 95% deposit has already been repriced, only 5% is remain. So I do not foresee there will be too much of the uptick in the cost of deposit also in times to come.
No, repricing you won't have a problem. Perhaps, as you point out, 95% is repriced. But as you go for fresh deposits, will there be a pressure on margins?
Definitely, because the cost of the new deposit, the incremental deposit has increased the 40 to 50 basis point in the last 1 and 2 months. So definitely there will be the pressure on the incremental deposit. But because as I told you, we are having 40 to 43% CASA, so not more than 10 basis point in the entire cost of deposit. I am thinking it will not increase much more.
But yeah, many congratulations for that. You're one of the few banks that showed a rise in your current and savings account ratio, your CASA ratio, by about 30 bips. Can that continue?
Because we are having 10,000 branches, pan-India presence we are having, so we are giving thrust to the opening of the saving bank and current account. So I think we will remain in the 42 to 43%.
Okay. Well, that's good to hear. We have State Bank results coming on Saturday. Let's see. They have more branches than you have. Let's see whether they are able to deliver. Now, you're one of those few banks where the loan deposit ratio is not, this ugly 80%, 90%, 100% that it is with some other banks. So that gives you a lot of scope to increase advances, even with the current deposits. What is the kind of advances growth guidance you can give?
You are very much right, Lata, because guidance we have given 12 to 13%, but after this post budget also we are thinking, because capex is also some of the company they are also thinking for the capex. So guidance is 12 to 13%. As far as gap in the deposit is concerned, we are not in a much difference in the deposit growth as well as the. I am having the 80,000 crore rupees extra SLR. So credit growth is not a issue for me.
No, that is the point. That's the point. Yeah, you're guiding only 12. That is why I'm asking you, will you do better than your guidance? Because there are so many banks who are going to forego their loan growth. I mean, HDFC Bank almost said that because they have to collect deposits at a higher cost. Many of them are going to forego their loan growth, and they are not alone. There are a lot of banks, private sector banks, where the loan deposit ratio is very high. So, therefore, will you do better than what you're guiding?
If opportunity will come for the advances, there is not a super guidance. We have given 12 to 13%. If opportunity will come for the, because there should be a demand also as on date. Yeah.
But demand, you have done very well on corporates and MSMEs. You are one of those few banks where retail has actually declined quarter on quarter. So can you explain both? Will you not go after retail for whatever reasons because of what the Reserve Bank's risk weights or anything? Or will you continue to go? And corporates, how is it that your corporate and MSME is doing so well? Will it What is the guidance there?
Lata, as far as RAM is in the range of the 55% and corporate is around 45%. The growth in the retail is more as compared to the corporate. Also, if you see my 12.90% growth in the total advance, whereas the growth in the retail is 19%, RAM is around 15%, and the corporate growth is the 10%. As far as we are not very, because unsecured loan on account of the RBI, whatever you are telling, my unsecured loan is very less. As a personal loan, it is only 26,000 crore rupees, and out of which 3,500 crore rupees is the education, then 4,000 crore rupees for the pensioner loan, and the pensioner loan out of 4,000 is the digital. That is working well also. Their NPA is 0.40%. So we are both sides. We are doing the both side RAM as well as the corporate, because we are the largest bank of the country. So our thrust on the corporate side also.
Quarter on quarter, your retail advances came down by about 2%. That's the only reason why I asked whether.
Yeah, that is right. That is right. Yeah, quarter to quarter, the thrust area is the focus area is the RAM, retail, agriculture, and the MSME also.
Okay, time permitting, I'll come back to this. But in a minute, I want to first look at your the huge recovery you have got, over 2,000 crores from written-off assets. Now, you have quite a few assets in NCLT. Can we expect, can you give us some guidance on recoveries going forward?
Our main focus, Lata, is on the recovery side also, and the last year also we have set a target of the 32,000, against which we have recovered 29,000. This year we have set a target of the 22,000, and we have already recovered 17,000. As far as NCLT is concerned, the first 2 quarters of the current financial year, recovery was within the range of the 500 to 600. Third quarter, the recovery was 1,800 crore rupees, and the last quarter of the current financial year, we are expecting the recovery of the 1,200 crore rupees. We are having the huge book of the technical return of account, around 90,000 crore rupees. This was the reason there was a recovery of around 2,000 crore rupees in the recovery from the return of account.
Okay, so can you just repeat the number? What are you expecting in terms of recovery this quarter and next? Q4 and Q1, you may have a visibility?
Because 70,000 crore rupees as against the target of 22,000 crore rupees, easily we will be in a position to recover around 5,000 crore rupees in the last quarter of the current financial year, and we can set the same number also in the next 2 quarters of the next year.
Oh, that's excellent. That's very good to hear. Can you therefore give us some idea of, of the cost side as well? You have set aside some money for wage negotiations, wage settlements. Will there be more of that will be settled, and can your credit costs come down even further? You brought your NPA down below 1%. So should we expect lower credit costs? And what do you have to say on wage settlements? Anything more in terms of provisioning?
Lata, first I will give the answer of the credit cost. Credit cost, if you see the 1.21% for the last quarter, and for the 9 months is around 1.5. So definitely it will be less than 1%, because my provision coverage ratio is around 94%, more than 94%, and aging requirement is reduced drastically. That is coming around 500 crore rupees per quarter. So it will be definitely less than 1%. As far as your question regarding the wage revision, revision for this quarter, we have provided 800 crore rupees, and 17% we have provided the wage revision from the November 14 to November 22 to December 23, because earlier we have provided September of 14%, the difference we have provided. So we have provided the adequate amount of the wage revision, because the 70% was set, it was there, but actually will be less than. So 17% is a very handsome amount we have already provided.
Okay. No, I just want to know in terms of guidance. Cost to income ratio has fallen, obviously, because credit costs have fallen. So can you give us some guidance on credit cost as well as cost to income? Can it fall even further from 51.2?
Yeah. As far as credit cost is concerned, that will be further fall, because that will be the less than 1% in the next quarter as well as the next year. As far as cost to income ratio is concerned, it will be remain within the range of the 50 to 51%.
Okay. Oh, okay, that's very good to hear. The market's kind. Will you be raising capital?
As far as capital is concerned, we have already got the approval of the board for the 12,000 crore for the current financial year. Out of which 7,000 was the tier 1 and the 5,000 for the tier 2. The tier 2 we have already raised 3,019 the current financial year, 4,153 crore rupees we have raised. Tier 1 also. So we will raise some Tier 1 also in the last quarter of the conference year. In addition to that, 7,500 crore rupees we have got the approval for the board for the next year, QIP and the FPO also. So that we will raise adequate time, yeah.
When will the QIP, I mean, will it be early because the market's good? Can we expect the QIP at an earlier date?
Because we have got the approval of the board in the last meeting also. So I think in first half of the next financial year, we will try to raise the money from the market by way of the QIP or FPO.
Okay, well, today the Bank Nifty is up 1.74 and it looks like it will catch up. Its problems are behind it. So we'll have to wait and see. That's why I was asking you if you would hurry. Thank you very much, Mr. Goyal, for answering so many questions about the bank and congratulations for a very good set of numbers.
Thank you very much, Lata.
Well, as we were speaking, we have seen a fairly decent jump. The Bank Nifty is up 1.7% and a large part of it is courtesy HDFC Bank up 1.4%, and that's courtesy LIC's announcement and the permission it's got from the Reserve Bank. Kotak is the other bank that's leading from the front, up about 2.6%, and another very big heavyweight. But the whole range of banks are doing well. But for the other markets, the broader markets, the Sensex in the Nifty and the broader markets, it's the Adani Group that's absolutely up and away thanks to Cantor Fitzgerald's report. We wrap up on Bazaar on that positive note. Chartbusters up next.